Everybody, welcome to Bonds Payable. We're at part one. We're going to talk about what is present value, and we're going to talk about present valuing a lump sum. So let's go through and look at some examples. If we invest $100,000 at 10% annual interest rate today on January 1st, 2025, and we reinvest the interest, what will the investment be worth on December 31st, 2026? And then if the interest rate is 8%, would I rather have $60,000 today or $100,000 10 years from now? So for this particular exercise, what we're going to go ahead and do is I want you to pull out the table that I was showing you earlier, the present value of a dollar. And again, I will leave the links in the comments below. Okay, so the whole concept over here with bonds and in terms of present value is what we're trying to say is that, what is something that if we invest something today, what is it going to be worth in the future? So if my investment amount over here, we'll call this the letter A, and then B, my interest rate. Okay. And if I look over here, my interest earned. Now, instead of investment, we're also can call this principal. Okay. So let's go ahead and start with this over here. So my principal amount on 1/1/25, and by the end of the year, and by the way, whenever I see an interest rate, it's always going to be an annual rate. So if by 12, so let's see over here. So by the end of the year or 12/31/25, I invested $100,000, right? So I actually invested it on January 1st, but at the end of the year, we're trying to go through and compute interest. My interest rate is 10%. So the amount of interest earned is going to be $10,000 or 100,000 times 10%. And what we'll do here is we'll basically say A times B equals C. Now, if we earn this interest and we reinvest that interest into the principal amount, my ending principal amount at the end of 12/31/25 is going to be the beginning principal plus the ending principal, which will give us over here, we'll call this D. Okay, so my ending principal over here is 110,000. Now, if I'm reinvesting the interest, right? So it's been a year that it's passed, right? This first year was from 1/1/25 to 12/31/25. If I go through and reinvest that interest, what is it going to be at the next year? Well, basically, it's going to be at 110,000. And if we have the same interest rate, now I'm earning interest on interest. So my interest earned is now going to be $11,000. So my ending principal balance is 121,000. So if we were asked, if on over here, 1/1/25, if we're going to be paid on 12/31/26, $121,000, what is that amount going to be worth today? Well, we know at a 10% interest rate, it's going to be worth $100,000, but that's not why we're here. How could we go through and figure out what that future amount is going to be worth to us today? The way we're going to do it is with present value. And this is so important for bonds because when we're dealing with bonds, we're going to be dealing with future payments that we're going to have to bring back to today's dollars in accounting. So my future payment amount is 121,000. Because this is a lump sum payment, it's a one-time payment, I need to bring this back to today. So what I'm going to use for a lump sum payment is I'm going to use the present value of a dollar table right over here. So I'm going to use present value of a dollar. Now, when I go to the table, I need to know two things. How many times was interest paid or compounded? We call that a period. And what is the market rate of interest? So I'm going to use 2 periods because there was 2 interest payments at 10%. So let's go over here. I'm going to see 2 periods at 10%, and this is going to be 0.82645. So let's see this over here, 0.82645. So the value of that $121,000 that would be paid 2 years from now, in terms of being what is that value today? It is going to be $100,000. Okay, so again, if we have a payment that's going to be made 2 years from now, what's the value today? Well, we already kind of figured out that this is going to be worth $121,000 2 years from now. But what is that value going to be today? Well, if I take the future payment amount of $121,000 and I go to the present value of a dollar table, very important, present value of a dollar. It is for a lump sum amount. It's a one-time payment. I'm going to go over here and I'm going to need to know 2 things. How many times was interest compounded or paid? Right over here, this is going to be 2 periods. Go over here to 10%, 0.82645. And what we come up with right over here is our $100,000. Now, here's the big question. If the interest rate is 8%, would I rather have $60,000 today or $100,000 10 years from now? And let's go ahead and check this out. If over here, I'm going to be receiving my lump sum payment is going to be $100,000. So my lump sum payment is $100,000. If I use the present value of a dollar table, and if I say, okay, how many times is interest being paid? Let's just assume 10 times or 10 periods at whatever the interest rate is. Here it is at 8%. So what I'm going to do is I'm going to go right over here. I'm going to say 10 periods at 8%. I'm going to get 0.46319. Again, this is the number of times interest is being paid or compounded 10 years at 8%. This is 0.46319. So let's go back to our table. So right over here, 0.46319. So the value of that $100,000 today is going to be 100,000 times 0.46319. This is going to be 46,319. So would I rather have 60,000 today or 100,000 10 years from now? You tell me. I'd rather have the money today, because even though the money is higher, if I can earn 8% on my money, I would rather have the amount 60,000 today because it's higher than the present value. Let's just go through for fun though and compute this out, right? So we're here to have fun. Let's have some fun. Okay. So right over here, if I go through and I invest 46,319, my interest rate is at 8%. The amount of my interest earned is going to be 3,706. If I add this to the principal amount, I get 50,025. If this goes over here to the next year, the interest rate has not changed. We're going to be using that same interest rate throughout the next 10 years. Over here, 50,025 times 8% is 4,002. So my ending principal is going to be 54,026. If I keep on going and I keep on bringing this amount and I keep on compounding that interest, what is this going to be worth at the end of 10 years? Well, it's going to be worth $99,000 or close to $100,000. But let's just see, just to kind of for fun, because we love to have fun. What if I'm investing $60,000 today? What is that going to be worth? Well, if I invested $60,000 today, and I got 8% interest on my money and I reinvested it, at the end of 10 years, this is going to be worth $129,535. So again, when we're looking at dollar amounts, this is what is so important. A dollar today is not the same as a dollar tomorrow. So if I look at this over here, if I'm going to get 100,000 10 years from now, I cannot compare that to $60,000 today. Not the same thing, because when you're looking at interest, those amounts are going to go through and grow. Remember, for all these examples, the big assumption here when you're using present value tables is I'm earning interest on interest, right? I'm going to take that interest earned, it's going to add to my principal, I'm going to reinvest that interest the following year. So just remember as you're going through and doing these types of questions to keep that in the back of your mind. So this question over here is when our big takeaway is when we are going to be dealing with bonds payable, right? Where the interest and the principal are being paid in the future, we have to bring it back to today's value, and we're going to do that with the present value tables. So I want to thank you so much for joining me here today. Please leave any kind of questions you might have below. I really appreciate the questions, the feedback. Appreciate you liking and subscribing to the channel, and I look forward to seeing you on the next video. Have a great day.